The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
We are live from Studio 2 at Bloomberg World Headquarters in New York City. I'm Matt Miller.
And I'm Bonnie Quinn. We're kicking you off to the closing bell. And it was a bit of an ebullient day already at the beginning of the day when we got the CPI data, and it was a little softer, which was to the market's advantage. And of course, put some Fed rate cuts back in the picture, perhaps a little bit earlier in the year than we had imagined. And then we got the news of a deal, a ceasefire deal, at least the phase one of a deal between Israel and Hamas. And that didn't hurt either. So we have risk assets across the board. We have the S&P 500 back in the green for the year. It had, of course, dipped into the red. Well, now we're up 1.9%. The Nasdaq 100 up 2.4%. You'd be hard-pressed to find stocks that are lower today. The 10-year yield down 14 basis points, 465. The dollar index did dip below 109. It is back above that right now, Matt.
First they're down, now they're up. A broad rally across the major averages, sending the Nasdaq 100 past 2%, the S&P in the green. For the year, the 10-year Treasury falling by more than 10 basis points, easing fears that a 5% rate for the benchmark bond is on the horizon. An easing core CPI is likely behind the party on Wall Street, with U.S. consumer prices rising less than forecast in December. Core CPI, which excludes food and energy, those things that you need, increased just 0.2% from month to month after rising 0.3% for the fourth straight month. The data reinvigorating bets that the Federal Reserve will cut interest rates sooner than previously thought. Of course, we saw those expectations come up and now down. Big banks also adding to the rally after kicking off the earnings season with blockbuster results. The KBW banking index currently up 4.2%. Like to see that, 420 there, after the four largest banks in the U.S. notched their second most profitable year in 2024.
Well, here to break down the action now we're seeing in the final hour of trade is Jess Menton, senior equities reporter with Bloomberg News. And Jess, you could really take your pick today, right? I mean, Matt mentioned the KBW Bank Index. There's also the SOX, and all the elements are higher everywhere.
It's the riskiest parts of the market that have been rallying the most so far today. So if you're looking at, especially Goldman Sachs has a basket of non-profitable tech. So if you move over and look at that, it's up about 4%. Actually, and also that put it on pace for its best day since January 3rd. And of course, you can't forget the Russell 2000, because small caps obviously been suppressed in recent years just given the high interest rate environment. So that's up actually around 2% on pace for its best day since the day after the election, as well as even looking at the most shorted stocks. So Goldman Sachs also has a basket there that's up more than 3% today.
So obviously, when rates come down, and at one point we saw the 10-year down the most since August, it means that those companies that need to borrow money, the money losers, are going to be able to do so cheaper. And that's why you see that huge rally.
Especially small caps, because they're domestically focused. They typically are the ones that hold more debt. And we've seen them, especially the Russell 2000. I mean, coming off the back of last year, that was the fourth consecutive year in a row it had underperformed the S&P 500. And it was its worst performance relative to the broader index since 1998. So you do tend to see these types of corners of the market pop on days like this. But it'll be important to see how does this play out in the next few sessions and if it holds.
Right. I was going to say, should we perhaps maybe not get too carried away, because after all, we did sort of give up all of the post-election gains between the beginning of the year and today. It's only today we're back in the green for the year.
And of course, we still have earnings driving a lot of things when it comes to the fundamentals, and not just fourth quarter earnings because those are backward looking, but the outlooks moving forward for the next few months as well as this year. Only about half of companies, though, tend to give annual guidance. So we're probably not going to get that. Usually it's more tech and discretionary oriented sectors. But on a quarterly basis, you tend to see a little bit more there. So that's going to be important to see, especially as you have a new administration coming in and what that could mean for individual asset classes. Yeah,
deregulation has been one of the big hopes. Tax cuts, obviously, as well. Are you seeing any of that come through in these rallies?
So the important thing actually is we saw an initial boost on that in November. So to your point, like we saw that.
But then it was erased, right?
Right, exactly. So the bank stocks, I mean, they're having their best day. You were talking about the BKX. It's best day since actually the day after the election, in addition to what small caps are doing. But of course, those didn't hold. So that's why it's important to see, does that hold? And we still have more banks that are going to be coming up. In addition, next week we'll have about 10% of the market cap for the S&P 500 reporting. But the week after that will be the busiest with big tech.
$22 trillion in market cap reporting the week after next.
Yes, yeah.
$4 trillion of that alone is just one or two companies, though. Bitcoin, how much is that related to this rally and how much is its own rally, in which case we better keep watching Bitcoin too?
Well, those are more of a kind of the crypto sort of focused type stocks. If you think of like MicroStrategy, Riot platforms that tend to look at that. I know Tom Keene usually tries to avoid when it comes to Bitcoin and things like that.
Bit dog, as he
exactly,
calls it.
He likes to call it bit dog, but that's more, of course, another speculative corner of the market. So when you see that popping as well, that kind of tells you some of the riskier corners of the market are the ones that have taken off and whether or not that can hold or not.
Yeah.
Bitcoin back up to $100,000.
It's really quite incredible because it was almost below 90. Well, it didn't quite break the 90, but it was.
That was kind of a support level too at the 90.
Yeah. And the VIX as well, we're not seeing a huge run up in the VIX. We did see it past 20, but it's back down to 16 now.
2 days ago, right?
Yeah.
I mean, I saw it at 22 a couple days ago and it came back down.
And also, Deutsche Bank had positioning data from discretionary investors at the end of last week, and that told you that it came off the highs from mid-November. So that kind of left some positioning there to where if the CPI print came in better than expected, it would add to a relief rally.
And you know what else is helping the energy companies today? We have oil above $80 per barrel. Nat gas settling at $4.07 on the front month. Kind of crazy.
Yeah, even WTI is over $80 a barrel, which I think is absolutely fascinating. Jess, thanks very much. Jess Menton there from Bloomberg News, senior equities reporter. And we are about to get to, I think, the big interview, it's safe to say, of the hour. Right now, we're going to talk more about bank earnings with one of the companies that did so well. We want to welcome our TV and radio audiences as we continue our market coverage and turn now to the banks with several reporting before the bell this morning. Wells Fargo shares are up after that bank reported net interest income for the fourth quarter that beat estimates and forecast an increase in 2025 net interest income. Joining us now is Mike Santomassimo, CFO of Wells Fargo. And Mike, I want to ask you about a potential Trump bump that came through in your numbers. I noticed investment banking revenue growth was strong in the fourth quarter. Is that as more people start to count on deals, as more people start to look to work with your advisors?
Well, first, thanks for having me. Look, I think what you're seeing across our businesses is a continuation of like good performance now that we've seen for a number of quarters. So it's not about a temporary bump that's coming. I think it's just continued execution across all of the growth initiatives that we've talked about across investment banking and some of what you're referencing in terms of deal activity potentially coming. And then I think it's just in addition, good continued strength in the U.S. consumer, where you're seeing good activity levels. You're seeing that come through in terms of the results in our numbers. You're seeing good credit performance. You're seeing good deposits levels. You're seeing good growth in credit card balances. And so it's a whole number of things I think that are really driving it. But it's clear people have a sense of optimism coming into 2025. As they look at the new administration, really, focused on pro-growth, pro-business initiatives, and I think that's creating some optimism for the year.
Yeah, even with rates, still high, even after today's drop, stocks really haven't gotten back to the highs that we saw at the end of last year, and yet we have a lot of confidence. I know the NFIB, the Small Business Confidence, the index they put out was up to the highest level since 2018. Is that coming through in loan demand?
Not quite yet. I think as we sort of talk to our customers, we're definitely hearing that optimism in the conversations, but it hasn't quite translated yet into demand for credit or many customers making big investments or building inventory because they think demand will be there. I think there's still, there's still a little bit of a wait and see, a little bit more prudence there in terms of thinking about it. But as the year goes by, if the macro picture continues to perform quite well, I think you'll see more demand as we get later in the year.
Mike, efficiency has been a big theme at all the banks, and I'm just curious, where are you in your efficiency push? What will be the highlights in 2025?
Yeah, well, I think it really started 4+ years ago, and since then we've delivered $12 billion of gross saves across the different businesses and parts of the company, and we've reinvested a lot of that back into people, technology, capabilities, products across all of our businesses. And I think as we look to 2025, our thinking is no different than it's been the last 3 or 4 years, where we still have a significant amount of opportunity, and we sort of highlighted that in our expense guidance for the year. And so, we think there's more to come there, and we're focused on continuing to deliver that, so we can continue to invest across the businesses for growth as well as efficiency.
So if you continue to invest, presumably hiring will be quite important. What will your priorities for hiring be, and also other investments?
Yeah, look, we've been hiring, across the businesses in areas that we want to grow while we get more efficient. And so generally that's in places, in client-facing roles across the commercial bank, the investment bank, our capital markets teams within our markets business, as well as in wealth management as we've continued to, recruit more advisors, not only to serve kind of the core wealth management channels, but also in our bank branches as well. We've been hiring advisors and bankers to support the effort there, and I think we're going to continue to do that, as we go into 2025. And we're happy so far with the return we're getting on a lot of those investments that we've made.
If we do see the Fed able to cut rates here, do you worry about net interest income erosion as you have to sort of bring up what you pay on deposits and the amount you can charge on loans comes down?
Well, I think what we've been seeing is actually deposit costs come down now that the Fed has started to cut rates, and so if we see further cuts, I think deposit costs will continue to come down. You'll also see loan yields come down as well, but I think we've already baked that into our forecast, and in our guidance that we gave today, we assume there'll be at least 1 or 2 cuts coming this year, but we'll ultimately see. And then there'll be a lot of other factors in terms of the level of deposits, the mix of those deposits, what we're seeing in the security side, as well as other opportunities. So I think there's a number of things that will ultimately drive it, and we're pretty confident in the guidance we gave at this point. Is there going to be more opportunity to give money back to shareholders, Mike? A lot of bank investors have been optimistic about that going into Trump 2.0. Well, I think we certainly have a lot of excess capital still here at the company, and I think we've now given back $20 billion. We bought back $20 billion of stock last year, and we'll look at the opportunities to support clients, and if we continue to see that we have excess capital this year, we'll buy back more stock like we've done. And I would anticipate that we will do some as we go into this year, but ultimately we'll see in terms of the overall quantum as we go through the year.
Mike, you did mention that the U.S. consumer is strong, but your CEO also said that cards, for example, is an area where Wells needs to get a little bit more profitable. Also, home lending. What do you intend to do about that? Is it a bank problem or a consumer problem?
Well, with credit cards, we've refreshed our whole product line in the last 3.5 years, and we've been in growth mode there to add new customers and new accounts. And when you do that in the first few years of that, you've got a number of upfront costs, either acquisition cost or accounting related to the allowance that mutes the profitability of those relationships. So it normally takes a few years for those relationships to become profitable just in normal course. And as I said, we're 3 years into sort of launching our first product. So it's just a matter of time, to start seeing more of that profitability in the card as the new vintages mature. In the home lending side, we announced a number of things that we were doing, including reducing the size of our servicing portfolio that we have there. And that just takes some time to execute. We're down 20% so far in that servicing book since we started the effort. And we'll continue to do that over the next couple of years to get to the right size we want. But those things we're pretty certain and confident that we'll get the benefits that we think there.
Mike, from Monday, we'll have a new administration. I'm curious as to what's your biggest hope for the next 4 years. Several of the executives on the banking calls today said that it should be a better environment for banks.
Well, I think broadly speaking, I think what's encouraging is the focus on growth and pro-business policy, and I think that's going to benefit everybody. Because for a bank like ours and most banks in the U.S., if the economy in the U.S. is doing well, we're going to do well too, because it means our customers are doing well, and there's lots of activity that's there for us to support them. And so I think people are very encouraged by what they're hearing and what they're seeing as it relates to the policies they're talking about. And so we'll ultimately see over the next few weeks and coming months in terms of what actually gets implemented. But this focus on growth and pro-business, I think, is what's encouraging, I think, for most people.
All right, Mike, thank you so much for your time today. Wells Fargo, the third best performer now in the KBW Bank Index, up more than 7%. That's Mike Santomassimo, CFO of Wells Fargo. Well, all the bank stocks are moving higher today after strongly beating expectations for fourth quarter earnings out of the likes of JP Morgan and Goldman Sachs. For more on the banking sector now, as we await Bank of America and Morgan Stanley tomorrow, we're joined by Jason Golberg, senior analyst at Barclays. So what could arrest this enthusiasm for bank stocks, Jason? Are we just going to hear more of the same tomorrow?
We think you will. I mean, you do have this dynamic that the bigger banks are reporting first. So they are certainly benefiting from a pickup in trading and capital markets, investment banking activities, and not necessarily hurt as much by kind of loan growth, which outside of credit card remains muted. So certainly as some of the more, smaller banks report that are more reliant on loan growth, something to be cognizant of. But listen, I think generally speaking, you've seen most banks beat both net interest income and fee income expectations while keeping expenses in control, credit quality benign, and share buyback persisting. And more importantly, I think their outlooks for 2025, reflect some of that enthusiasm you were talking about, given this new administration coming in, with most banks pointing to higher net interest income growth and fee income as they look ahead.
So today we had a repricing once again at 24 hours ago, we were looking at maybe one cut from the Federal Reserve in maybe September, October time. Now we're looking at potentially two and might start in July. Are the banks able for this kind of volatility? Is every kind of volatility good volatility?
No, but I think, from the perspective of, whether the Fed cuts 25 basis points in 2025 or, 50, 75 basis points, on the margin, it doesn't matter. I think, as long as the Fed moves at a measured, predictable pace, banks have the ability to, manage around that. And what you've seen over the last couple of years is most banks move on their balance sheets to more rate neutral positions. Certainly as the Fed hiked rates aggressively in 2022 and 2023, some banks got caught off sides. And I think you've seen kind of most banks move to a more neutral position. So, a little bit here, a little bit there doesn't really impact it. I think the biggest driver of net interest income, during the course of this upcoming year will just be loan growth, as that's your highest yielding asset.
We were just talking to Mike Santomassimo at Wells Fargo. He pointed out they bought back $20 billion worth of stock last year. Citi said today they're going to buy back $20 billion of stock. It's crazy that I'm going to ask this, but do you think banks are going to be able to return even more money to shareholders as we get into the Trump administration?
We do. I mean, I think, interestingly, and just, Trump hasn't even taken office yet, and we've already seen Fed Vice Chair supervision, Michael Barr, who's been very stringent around new capital rules, say he's going to give up that position. And then the day before Christmas Eve, the Fed put out a statement saying they're going to look to both increase the transparency of the bank stress test as well as reduce the volatility. So as we look ahead, to the extent that the new administration takes a more holistic approach to both stress testing, the new Basel III capital reforms that I've been talking about for the last several years, and something called the GSIB surcharge, it will allow the banks to, I think, more freely manage their balance sheet. And I think one of the outcomes of that will be an increase in share repurchase.
In terms of the tax implications, do you think that that's going to also be a tailwind for banks this year?
Yeah, ultimately we have to see what happens. But the majority of most banks outside of a few, revenues are in the U.S. So to the extent that corporate tax rates get further reduced, that will benefit. And then to the extent it spurs economic activity or investment, that also will kind of flow through the banking system.
What about the smaller banks? And by smaller, I don't mean small. I mean, the key corps and so on. Is there going to be some consolidation this year, Jason? Where should we be looking for that?
Yeah, so listen, the number of banks in the U.S. has halved in the last 20 years, and we think will halve again in the next 20 years. So that, is over 2,000 acquisitions we expect, and we think it'll be, banks of all shapes and sizes. There's certainly, economies of scale in banking. The larger banks have, better efficiency ratios. And ultimately, I think once there is, clarity around, what the regulators want from deals, and I think there's been some ambiguity over the last few years, I think that could prove to be, a catalyst for further consolidation.
So, Jason, is it a case of carte blanche by all the banks at this point, or are there some you would definitely stay away from for 2025?
Listen, we cover like the top 20 banks, and in that lot, generally we are constructive. You certainly have to be mindful. You have seen an uptick in non-performing assets this quarter, as well as loan losses. So things like lower-end consumer, commercial real estate, particularly office, and certain pockets of C&I, you got to be mindful of with respect to loan losses. Although, I think most of the bigger banks are fairly well insulated.
All right, Jason, thanks so much for joining us. Jason Golberg there. He's a senior analyst at Barclays talking to us about the banks after all of the G-SIBs that reported today had blowout quarters. We will be back right after this. This is The Close. Time now for our top calls. A look at some of the big movers on the back of analyst recommendations, starting with Devon Energy, an upgrade to outperform and a $45 price target from analysts over at Bernstein. The firm has a strong conviction in the U.S. gas landscape and expects Devon to benefit from significant demand growth to help power those AI data centers. You can see the shares up 3 2/3%. Vonnie?
Well, Matt, I'm taking a look at toy maker Hasbro. Roth MKM analyst Eric Handler lowered its price target to $68 from $82. He's still confident in Hasbro's turnaround story, especially from its popular Wizards of the Coast fantasy game. But he's cutting his price target due to disappointing toy sales from this holiday season. Shares of Hasbro down 1% now.
Finally, William Blair kicking off coverage of digital fintech companies Affirm and SoFi. They say SoFi is leading in personal student, mortgage, and credit card loans for prime customers. Also under the leadership of CEO Anthony Noto, SoFi has what it takes to eventually top more traditional bank services. They have an outperform rating on the shares. You can see SoFi killing it right now, up 6.7%. And we're happy to have the analysts behind that last call joining us right now. Andrew Jeffrey, research analyst over at William Blair. Andrew, thanks for joining us. Talk to me about SoFi and why this isn't already priced in. You know, what happened with SoFi last year?
Yeah, Matt, thanks for having me. Yeah, I think what you saw last year in SoFi and Affirm as well, which we initiated with an outperform today, is I think that investors have finally reached the point where there's an appreciation for the merger of fin and tech, hence fintech. And I think that SoFi in particular embodies the future of commercial banking and traditional, as opposed to traditional banks. I know you had CFO of Wells Fargo on earlier today. And from my perspective, I think SoFi is just a better solution. I think younger consumers are going to demand better digital experiences, more products, additional abilities to save, spend, invest, receive financial advice and guidance, and ultimately access instant lending decisions. It's just a better model. So, you know, whether or not the stock's moved, we don't think it's priced in long term.
So, Andrew, how do you decide who are going to be the winners and who won't be, right? Who will have the moat that it takes in order to sort of land grab? Because that's what this is effectively, right? I mean, everyone is dealing with the same interest rates.
Sure. Well, I think there are a couple of things to keep in mind. Wells Fargo doesn't offer any interest on savings. SoFi is offering 4% interest on savings with direct deposit. That's going to attract a lot of deposits. And I'm very confident in the company led by Anthony Noto to deploy those deposits in high return products, whether that's lending products that are more traditional bank solutions, credit cards, other types of products like investments, spending products like debit cards where the company generates interchange. And I just think generally the selection of the company's products that the company offers, as well as the consumer experience, is so superior that when you look at a company as small as SoFi, on a relative basis, less than 8% or less than 10% of the number 10 largest bank by deposits in the country, and only 9.5 million or so members on a potential base of 200 million. If a land grab is the way you characterize it, that's fine. This company's the winner. It gets fat on the scraps that fall off of JP Morgan's and Wells Fargo's table, in my view.
Yeah, I should point out both of these companies, both of these stocks did well last year, did fantastic in 2023, but I think of them as falling because of 2022. Are they going to get back up to the sort of COVID highs?
Yeah, I mean, I'm not going to look back to the COVID periods. I think that was such an aberration. I think it's reasonable and important for investors to recognize what happened in 2022, namely the fact that liquidity dried up, secondary markets were frozen. These are more diverse funding models today than they were 2.5 years ago. That's one thing. I think management's learned a lot from that experience. And I think both have proven their ability to drive liquidity and profitable growth irrespective of secondary market conditions.
Andrew, thank you so much. We do have to stop there, but we will resume this conversation very shortly. That is Andrew Jeffrey over at William Blair. Do stay with us. We'll be right back here on Bloomberg Markets.
Just after 3:30 p.m. in New York City, this is the countdown to the close. I'm Matt Miller.
And I'm Bonnie Quinn. And markets are ramping up. Matt, look at that. The S&P 500 up 2% now, 113 points.
Yeah, that is a solid rally. We're back up to like 5960, so just 40 points and change away from 6,000. It had been a pretty depressing year because we were so worried about inflation.
Well, it was just a repricing constantly, right? After we got the jobs data
and then suddenly,
exactly, and suddenly the PPI. And I just want to point out, Bitcoin is now above $100,000 a coin again.
Shh. Thank goodness, right? I was so worried that Bitcoin had dropped all the way down to the depths of $90,000.
Somehow I don't ever see you being worried. I don't think you have a worry line on your face. Well, today's CPI print didn't give much cause for worry. It showed underlying inflation softening for the first time in 6 months, leading some traders to adjust their expectations for how many cuts we get from the Federal Reserve. Last week, Bank of America economists were among those to make the bold call that the Fed's cutting cycle is over. Earlier today, we caught up with Bank of America to see if today's CPI data changed that forecast.
I don't think it changes our mind, really. It's a good number, 0.2% on the core PC. We were below consensus at about 26 basis points. This was even softer than that. If you look over the last 3-4 months, we're basically running at around 2.5%. Which is where the Fed thinks we'll be at the end of this year for the core PC. So by the Fed's own admission, inflation is stuck around 2.5%. And then also on top of that, the labor market seems to have stabilized. And that was the primary reason they were cutting. So we don't see any reason for them to keep cutting now going forward.
Joining us now for his perspective is Randy Kroszner, professor of economics at the Chicago Booth School of Business, also obviously former governor at the Federal Reserve. So Randy, I'm just curious, we had been actually talking about maybe thinking about the possibility of a hike this year. Does today's CPI data completely take that dialogue out of the equation now? Are we still talking about cuts, and if and when?
I think it's really important for the markets to kind of take a deep breath. These are just one-off numbers. It was the jobs report was stronger last week. This is slightly weaker than expected today. The Fed doesn't make decisions, especially the long-run decisions over the year, based on 1 or 2 data points, but on how all the pieces of the puzzle fit together. I think broadly things are consistent with the Fed's broad forecast that they would do 1 to 2 cuts for the year. I don't think we're going to get a lot of cuts, but I think no matter what, even if the Fed does cut 50 basis points, the 10-year rate is not going to come down a lot.
Well, it came down a good 15 basis points just in the last 24 hours. So I guess, it depends on your definition of a lot. But I am curious if you are worried about inflation expectations, because we saw those rise up a little bit as well. The Fed chair and all the Fed chairs before him have talked about being concerned about anchoring inflation expectations. Is there any chance that they could get out of hand, especially if we start seeing tariffs?
It's certainly possible that it could happen. I don't want to dismiss that possibility, but I don't think that the tariffs are going to provide a very strong boost to inflation pressure. One, it's a one-off rather than something that's ongoing. But even if they do try to mitigate the impact by amount that will gradually go up, that's still not going to have an enormous impact on the overall price level, because imports are only 15% of U.S. GDP. So even a 10% tariff on all that doesn't lead to an enormous increase in the price level and won't lead to that much inflation. The run up in the 10-year rate over since President Trump has been elected has mostly been so-called term premium, not inflation expectations changes. And what happened today is that that term premium came down a bit. And so what I was saying is that I think that you're not going to get this just sort of parallel shift down along the curve. I think you'll get, if you do get Fed cuts, they're going to be at the short end. The long end is not going to be driven down that much by that. And so I think anyone who is hoping that the 10-year rate is going to come down substantially this next year and that'll bail out commercial real estate or bail out another sector, I don't think that's going to happen. I think they're going to be sorely disappointed.
Randy, what do you think about labor costs? We saw a blowout number on non-farm payrolls last week, and with the LA fires, I have started thinking about how they're going to get enough construction workers to build houses. I heard an anecdote about ICE showing up in Bakersfield, and all of a sudden, no agricultural workers were there anymore. With mass deportations, a major plank in the Trump platform, are labor costs bound to soar?
So if you look at the labor report from last week, even though the jobs numbers were up substantially, the actual hourly wages were down slightly and down a little bit, so less than or growing less rapidly than had been expected, a little bit weaker than in the previous months. So at least so far, we're not seeing that. Certainly,
well, they haven't started yet.
Yeah, but that's why I think it's really important to put the context in, put it in context that last week's labor market report, certainly the numbers were up, but the inflation pressure in terms of wages was not up. Certainly, if you take out a large part of the U.S. labor force, wages are going to go up, no doubt about that. Now, how much will that be? How much actual deportations will there be? I think what we're hearing is that that's going to be very difficult to ramp up. It'll be focused on a smaller number of workers to begin with, but certainly all other things being equal, that's going to put more pressure on the labor market for sure.
Well, if we don't see huge deportations and tariffs don't cause much inflation, we're left with tax cuts and deregulation. Do we see great growth this year? I mean, are we looking at a bang-up economy in 2025?
Well, I think there's the potential for that because I think you're going to see, obviously, you've already seen that excitement in the markets, and you've also seen that excitement in investment. You had a lot of optimism about AI and investment in NVIDIA chips and technology. So I think that's going to be driving something very important, independent of policy. And then you also have a lot of business optimism about regulatory changes and tax changes. So I think that's going to help to offset some of the drags that may come from, we've got higher real interest rates. We had almost 15 years since the global financial crisis where real interest rates, that is the inflation adjusted rate, was negative, and now it's turned positive. That, of course, all other things being equal, is going to have a negative offsetting impact. Makes it more difficult for people to afford homes. Makes it more difficult for some of that construction that you were talking about in LA to come back to happen. And so you do have some headwinds, but those regulatory changes and tax changes, as well as the general optimism, and especially the tech optimism, I think are going to help to power the U.S. economy for much of the year.
Randy, what's going wrong, if I can put it that way? Why is it so difficult to forecast what this economy needs and will need in 3, 6, 9 months? And will there be more dissent at the Federal Reserve over this?
Well, I think whenever you're at a situation where you've got a lot of geopolitical tensions, an enormous amount of geopolitical uncertainty, which has an impact on energy markets, and you've got a lot of political changes in Europe, obviously political changes in the U.S. and uncertainty that's here. So we're just not quite sure. And I think that's one of the things you're hearing from some of the Fed speakers is, well, what if? What if tariffs do this? What if taxes do that? What is going to happen to the federal deficit? Because that's also a very, very big factor. And it's not only the U.S. that is doing a lot of government borrowing, but most other major countries are also doing a lot of government borrowing. All other things being equal, that's going to put pressure on the longer term rates because there's just so much demand for government borrowing.
Randy, great to get some time with you. Really appreciate you coming to us. Randall Kroszner there, professor of economics at the University of Chicago Booth School of Business. Now, we have a new report from LinkedIn today, found that 88% of C-suite leaders say speeding up AI adoption is important over the next year. Here to discuss more of those findings and how AI will change the workforce is LinkedIn's chief economist, Karin Kimbrough. Karin, thanks for joining us. When I think about this, last year I talked to some employees who were a little bit embarrassed about using AI for their jobs, even though it was making them more efficient. Now I talk to people who expect their employer to pay for their AI subscriptions. Are we moving to a place where, your ChatGPT Pro subscription becomes like Windows, where your boss basically puts it on your desktop for you?
I think we're going to see AI permeate all aspects of the workforce. So, yeah, I think it's fair to imagine at some point employers are going to be expected to provide those really, frankly, essential technology tools to all their workers. And this is across all kinds of industries, whether you're talking manufacturing or consulting or banking, whatever it may be. In fact, when we look across our world of data at LinkedIn, what we see is that employers are increasingly looking for AI skills, whether it's really technical skills or just the basic AI literacy. So we're going to see that permeate through all aspects, and we're going to be expecting to see workers upskill accordingly.
What kind of effects do you see AI already having? I mean, is it really improving efficiency?
Absolutely. I mean, I'm a user, I'll tell you. It's one of those things where we already see people finding they save hours, even days of time using, say, Copilot or ChatGPT. And we're finding that the career market is changing. The world of work is absolutely changing. We're seeing people that are holding more jobs than in the past. So professionals who are entering the workforce now are probably going to hold 2 times as many jobs as they did 15 years ago. We're seeing workers expecting not only to upskill themselves, but their employers to provide that. And the share of people who are adding skills is like 40 times higher than it was, nearly a decade ago. So there's a lot of movement happening, and it's not just in the world of AI and skilling, but it's also creating new jobs. So for example, we're seeing jobs that didn't exist in the year 2000 that are suddenly permeating our platform. If I look across just the US, 20% of workers who took a new job last year in 2024 have a job title that did not exist in 2000. That's 20%. So it's an enormous amount of new job creation that's happening in tandem with AI starting to infuse across the workforce.
Karin, one of the other things that you found at LinkedIn is that the number of applicants per open job has jumped from around 1.5 in 2022 to 2.5 in 2024. Now, what does that mean? Is this a little bit like the job openings and labor turnover survey, or does this mean something different, that LinkedIn just makes it easier to apply for a job and people are applying for many more than they typically used to?
I actually think it's both. So I think what we're seeing from the latest jobs market report and what we see in our own data at LinkedIn is that hiring is starting to pick up. It's getting a lot more momentum than it's had over the last 2 years. In our own data, we're seeing hiring rates that are actually starting to turn positive for the first time in 2 years. And so it's hinting to me that we're at this point where maybe we're entering 2025 with a really nice springboard to see more momentum in the labor market. And when I say momentum, I mean people changing, people applying for jobs. 3 in 5 of our members tell us that they want to apply for a new job in 2025, but they're also telling us that they're applying for more jobs than ever and hearing back less. And the problem is partly because it's not a problem, it's great. It's easier to apply to jobs, but you need to find that perfect match, and mismatch can be a risk. At the same time, employers are casually starting to open up more jobs, open up more roles. But overall, as you point out, the competition for jobs is still more fierce than it was a few years back. And we definitely see more applicants per role now than we did even a year ago. So it's definitely more competition, which makes the match all the more important in the job market.
Have you the ability to tell if somebody is using AI, in fact, to apply for a job? And is that something that you would not recommend?
I think actually it's fantastic to see people use AI to help them become more efficient, more effective. And if it's helping them craft the perfect cover letter, or if it's helping them figure out what's the best possible set of skills that I need to showcase for a role, then absolutely they should be using it as a tool in their job search. We're seeing both recruiters and job seekers making use of AI to help make themselves more competitive, to figure out what kinds of LinkedIn learning courses they want to train up for, that figuring out what kind of jobs are the best fit for them. So I think if anything that gives you more information is a positive. I don't think of it as some kind of shortcut,
We recently had a story, JP Morgan calling all of its bankers back to work in the office 5 whole days a week. It's obvious why I think an employer wants workers to come back to the office. It's also pretty clear to me why an employee would prefer remote work. How's that tug of war going?
Yeah, I think that tug of war is definitely in play. It's been in play for a while. In the US, it's one of the areas where people are most prone to be looking for remote jobs. It's partly tied to the housing market. And I think really what's going to happen is it's going to come down to how tight or slack, if I can use those words, the labor market is. How hard is it for employers to hire, or how hard is it for job seekers to find the right match? Right now, it's about evenly balanced, and it's a healthy, robust labor market, as we can see. But if the power balance tilts towards the employers, they're going to start to want to pull more and more people back to the office for more and more days of the week. But I have to say, people have had a taste of that flexibility, and I think they're going to be loath to give it up easily.
Karin, thank you so much. We'll continue to monitor these reports as they come through, and our appreciation to you. That's Karin Kimbrough, Chief Economist at LinkedIn. And of course, we just have 15 minutes in the session, Matt, and it looks like these gains are holding. If anything, we're seeing even more gains into the close. Yeah, it's pretty phenomenal to see a 2% day on the S&P. It's one of the best CPI days in my memory. The Dow Jones Industrial Average, if you still care about that, up 760 points. Coming up, we're going to take you to the closing bell with Katy Kaminski, Chief Research Strategist with Alphasimplex Group. This is The Close.
What we've been seeing is actually deposit costs come down now that the Fed has started to cut rates. And so if we see further cuts, I think deposit costs will continue to come down. You'll also see, loan yields come down as well. But I think we've already, baked that into our forecast. And in our guidance that we gave today, we assume there'll be at least 1 or 2 cuts.
That was Mike Santomassimo, the CFO of Wells Fargo, kicking off the show. And what a show. We had just green all around the screen. I mean, there were a few stocks obviously lower, and Fannie Mae dipped 13% towards the end of the session, which was an interesting one, having started up 10-20%. But look at this. We have put some green on for the year. Now, there are another 10 minutes to go, obviously, Matt, but right now the S&P 500 is up 1.8%. The NASDAQ 100 is up 2.3%, and it's off its highs of the session. The Russell 2000 is up 2%. We have the dollar index at 109. We have those rates down 10-15 basis points at 4.65 on the 10-year. And of course, we have Bitcoin, which is now just dipped below 100,000. But it just goes to show that all of the asset classes basically are rallying. Do we have time for a dollar index rant?
Yeah, go for it.
Okay, so DXY, which is popularly used on Wall Street,
against the basket of the
weighted
major trading partners
in the 70s, right? And only against 6 major currencies, none of which are emerging market currencies.
Correct.
Actually, 57.6% of DXY is just the euro.
Well, then that's not
so
great.
So the Bloomberg Dollar Index changes that. We put emerging market currencies in there, like the yuan, like the Mexican peso, for example, and they're trade weighted in a dynamic way that adjusts always. So it's really a much better measure.
So what's the BBDXY
of dollar strength? BBDXY is, I'm going to guess, down as well today because. Yeah, down about 0.25% at 13.11. I just like to use that benchmark better than DXY.
Yeah, because
I don't mean to take up too much time.
We don't trade with just 6 partners, right?
Yeah, or with 60% euro, right? Let's bring in Katy Kaminski right now, not to talk about that, but she is Chief Research Strategist at Alphasimplex Group. And in terms of the rally we saw today in stocks, almost 2% on the S&P. In terms of the drop that we saw in bonds, right, 15 basis points off the 10-year. Is that all justified, you think, by this one CPI reading this morning?
I think That's a good question because it's pretty extreme, the move that we saw today. If you look at how equities have behaved, we've seen equities in a pretty consistent downturn and signals decreasing, and short signals in bonds have been very strong. So people have been very pessimistic on bonds, thinking yields are definitely going to be much higher. And I think today, it just maybe was a slight indication that things were better. So perhaps it is a little bit of an overreaction, or at least a big relief. It definitely was a big relief, but maybe we should think that CPI is still not down to target. So we'll see. It's still due, but it's been a big day.
It is, the core number is what beat, right? The headline number was still 0.4% month over month, or 2.9% year over year. The super core, someone pointed out to me, is really low, but that strips out like literally everything that consumers need to buy. When you include the stuff I have to pay for, like gas, food, and housing, then it's really the headline number that I'm looking at. And the Fed has a lot of work to do. Can they really be cutting rates right now?
This is a great question. And I think, let me go back to, I know you don't like the DYX, the DXY much today, but like, look at it. It didn't actually drop. And what we have typically seen is that yields have gone down, and also the dollar has gone down whenever the Fed is likely to cut. So I'd say I'm seeing a little bit of a mixed signal for that, in that I think a lot of people are hoping for lower rates, and the fact that rates have gone up so much, it's not surprising that that might have been a little overextended. But I do think the Fed has a long way to go, given how high inflation hasn't come down to target yet. So the longer term goal is less clear, even though shorter term we might anticipate a little bit of a reversal.
So, Katy, you definitely could explain away today with that CPI report, and also a lot of goodwill out there, right? We had sold off, the indices were in the red for the year. It's already sort of mid-January, so we needed a rally if we were going to get one this month. And then, of course, we got the news of the ceasefire, which doesn't hurt matters much. So I'm just curious, can this continue? Does it depend on earnings? I mean, the banks obviously put a big boost into the equity markets today too.
Definitely. I mean, I think we're moving into earnings season. If earnings are positive, that's another positive reason for momentum, for some recovery in the equity markets. I think this dance with how the Fed is going to go and where rates are going to go, frankly, a lot of people are kind of waiting to see to next week and sort of how policy changes and other issues. So I do think there's some indications that things could be good and earnings will help. But we still have a lot of things to figure out, especially going into next week.
Katy, would you be changing what you have right now? Would you be allocating more to cash? Would you be getting out of some of the stocks that we've seen a pop in today, for example?
Well, I think today was such a big move. It kind of showed, I think a lot of people may have also been buying the dip in some sense as well, is that you're kind of thinking, well, there's some positive indications. We have seen some trimming of equity signals. So that would mean perhaps being a little bit more cautious right now until some of the issues are resolved. I think fixed income is going to be the biggest wild card, especially given how much rates are up. I think a lot of investors thought if things could get better, it's a good buying point to get in with higher yields. But I do think there is some general shifting across, but not in the dollar, clearly, which is what I mentioned earlier.
Well, you know what? A lot of these things I would have expected going into the Trump administration: stronger equities, higher rates, stronger dollar, with the exception of today. Oil, I would not have expected. Even WTI is up above $80, even with the ceasefire news. Why is the oil market, why are prices so high?
Oh, that's a good question. I mean, I think we've seen that trend over the last few weeks. There's been a lot of oscillations in oil prices. I think, they're not up to overall, resistance levels on the upside yet, but you've definitely seen a lot of oscillations and it has moved up a little bit more. There's not really a clear indication because usually we're seeing that oil prices have a lot to do with demand in China, and there hasn't really been any news on that. So I think higher oil prices could just make this inflation narrative more challenging, which is probably what investors should be focusing on for oil.
All right, Dr. Catherine Kaminski, thank you very much for joining us. Katy is the Chief Research Strategist at Alphasimplex Group, talking us through a day on which the S&P 500 is up 2% and the 10-year yield is down 15 basis points.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
All right, about 2 minutes away from the end of the trading day. Matt Miller here with Vonnie Quinn, and we're going to help take you through the closing bell with a global simulcast. We're joined now by Carol Massar. It is my great honor to be joined by Carol Massar and Tim Stenovec, bringing together our Bloomberg Television, radio, and YouTube audiences worldwide to parse through the most crucial moments after the open, of course, of the trading day.
Yeah, keeping us busy and on our toes today. I keep thinking about the big banks, Matt, and the outperformance there, just the blockbuster numbers. And, you know, you take a look at the KBW Bank Index, it's up more than 4%, so outperforming the overall market. Looking forward to kind of the rest of the banks to kind of come out with their numbers.
Yeah, still waiting on Bank of America. We'll get that one tomorrow morning. When you talk crucial moments of the day, I mean, it was before the market opened. It was when that CPI report came out, Vonnie, I think. Look no further than Bitcoin.
Really?
Yeah, I did it. I did it. Mm-hmm. Hit $100,000 once again. Finally, back up there. 99,500 per Bitcoin right now.
Problem is, you probably mentioned it on air. I did too, and then it dipped back below $100,000. So we jinxed the Bitcoin community. Sorry about that, Bitcoin community. I'm also just, curious as to how this market is going to react for the rest of the week. Don't forget, we also get Joe Biden's sort of exit speech tonight.
I will never forget not buying Bitcoin at $75 a pop. It's painful.
But
every time.
Matt, you would still be here with us.
Of course.
Had you done that?
I mean, it's only $100,000. It's not $1 million.
I wouldn't quit my job just because I made a few $100 million.
Really? Oh, yeah, $100 million. That would be fine.
There you go. Closing bell. And what a rally. Not quite the level, I don't believe, that we saw in November of 2023 when the S&P was up a solid 2%. That was the last time you had such a big move up on a CPI day. But we do have a gain of 1 2/3%, almost 700 points on the Dow Jones Industrial Average, 43,214 the level there. The S&P 500 up 1.8%, more than 100 points on the day to 5950, and the NASDAQ gaining 2.5% to 19,511, Carol.
Yep, I call that a rally, no doubt about it. Hey, Matt, I'm going to go back to the S&P 500, up the most since November of 2024, so early November of last year. And if you look at the S&P 500, Vonnie, you've got most names in the index higher today, 369 names, 369 to the upside, 134 to the downside.
Yeah, it's very, very tough if you look in the map to actually find a company that's in the red. Look at that tiny, tiny little sliver up there. You're talking about a couple of consumer staple companies, but consumer discretionary sort of took the lead, right? The group as a whole was up 3%. So consumer staples, perhaps things like food and beverage and tobacco down, and just pulling that down by just 1/10%. We're really talking about green across the board here.
All right, so let's get to, I had so much to choose from.
Carol
Tim
Massar, that's enough.
He was super, super jealous. A lot of names to choose from. So I kind of went to an index to kick it off, just to represent all of the big banks, because every name, 24 in the KBW Bank Index, are higher today, folks. And so the index overall up more than 4% in today's session. The 4 largest U.S. banks, as you know, reported their numbers before the open. The second most profitable year ever in 2024, driven by interest rate moves, investment banking fees, and market swings. So, whether it's Goldman, whether it's Wells, whether it's Citi, helped up by news of a $20 billion buyback. All of them really just up across the board. Another name that really caught my attention, this is the number 2 gainer in the NASDAQ 100, Intuitive Surgical. This one up 7.6% here, and it may be a record close. I got to pull it up. I'm going to do that. In the meantime, this is after the company reported preliminary revenue for the fourth quarter that beat the average analyst estimate, and it is, I believe, at a record close in today's session. And then here's something a little bit different. Beacon Roofing Supply, ticker is BECN. It's a $7.3 billion market cap roofing and building materials company rallying. This is after QXO, that's the company run by Brad Jacobs, former CEO of United Rentals, United Waste. He proposed buying the company for $124.25 in change. The stock closing at $117 in change. That deal, an offer in cash, implying a total deal value of about $11 billion. So that's about a 37% premium to Beacon's 90-day average price. So this one was definitely a standout in today's session, Tim. All right. What did you find, Tim?
Yeah, not much. Well, in a market with so much buying across the board, kind of hard to find decliners, but I did it, guys. Southwest Airlines down 1 percentage point exactly. Why do you call it that, Matt?
Some say.
Well, why are they down? Right? I mean, just way too many cancellations and delays.
But they could go from Southwest to Southwest very easily, right?
Maybe that is the perfect segue. The U.S. Transportation
there are any
Department.
lawyers out there watching.
The U.S. Transportation Department suing the company earlier today for allegedly violating rules that require airlines to set and meet realistic flight schedules. According to the government, the carrier was responsible for, quote, chronically delayed flights that disrupted passengers' travel plans. The Department of Transportation said it would seek maximum civil penalties. Southwest, in a statement, said it was, quote, disappointed that DOT chose to file the lawsuit over 2 flights that occurred more than 2 years ago. Still, we did see shares fall after that news broke. And Vani, you mentioned tobacco companies. Shares of Altria Group, ticker MO, down 0.6%. All tobacco company shares, or I should say multiple shares of tobacco companies, fell after the FDA said it's pushing ahead with plans to cap nicotine levels in cigarettes. The FDA saying that it would cap nicotine levels at 0.7 of a milligram of nicotine per gram of tobacco. The average nicotine content in the top 100 cigarette brands for 2017 was 17.2 milligrams for each gram of tobacco.
Cigarettes.
So that's quite a difference. Well, you bring up a good point, and hence why the stock is lower. The proposed move is designed to make it easier for smokers to quit and to prevent others from starting. So do the math. If they're less addictive, if they're easier to quit, if people don't start as much, it probably means fewer cigarettes, Matt.
It's not, I mean, actually, I've been watching Landman lately.
Oh,
yeah. I have one episode left. Don't spoil it.
They must be sponsored by Marlboro. I mean, so many people smoking in that show. But in real life, I mean, people smoke weed, right? But no one smokes cigarettes anymore.
I think the rates certainly have declined in the U.S. Outside of the U.S. is still a growth area for some of these companies.
But interestingly, Tim, did you see that they have actually banned it outdoors in Milan now, which I thought was fascinating because Milan is a place where 1 in 4 smokes still. I mean, Europe is obviously much bigger of a smoking community still than the United States.
That's a really big deal.
Yeah.
Okay, that's interesting. Hey, finally, I did find one more decliner. Albertsons companies fell 1.5%. The grocery store operator, Matt, said it will implement layoffs. They said, quote, after many years of productivity efforts, we recently turned our attention to our general and administrative expenses and made the difficult decision to reduce the size of our corporate division support workforce. Shares down about 1.5%.
I just want to point out that I have had a lovely time whenever I've flown Southwest. It's just too easy.
Is that the lawyers or Southwest that call?
I have flown Southwest. You know, it's one of those planes, airlines where you hop, do the hops.
Puddle jumpers.
And you know, I've always really liked it. In terms of yields right now, we had at one point the biggest drop in 10-year yields since August. In fact, I see the 10-year yield down 14.3 basis points. We could be there with that at 4.649%. So under 465 on the 10-year. A week ago, that still felt really high, but right now it feels just relaxing. You can see the 30-year yield up down 10 basis points at 487, and the 20, which is my favorite tenor, still at 494.46.
Hey, I just want to point out, too, the market's fear gauge, the VIX, collapsing the most this year. It was down 2.6 points to 1608. So just interesting to see a huge market reset, but we certainly could get this again. Hey, folks, one story on our radar has to do with the fires out on the West Coast and the entertainment industry. Hollywood studios, Walt Disney resuming filming TV shows indoors with the exception of one series. So we're starting to see some of the activity in the entertainment industry come back on the West Coast, the LA area.
Okay, so you mentioned Walt Disney. Work on the film The Hand That Rocks the Cradle has also resumed. Walt Disney said last week a number of film and television productions in LA fell by about half from a year ago, of course, due to those wildfires burning in the region. That's according to Film LA. Vani, those fires still not out yet.
No, and a tough road ahead,
yeah.
and the wind is going to be crazy this week as well. So you do like to see as many parts of the, market that can get back up on its feet and keep things kind of moving as possible. And of course, that industry is just paramount, literally, to Hollywood. The story that we were looking at is maybe a little bit less serious, although
it's serious.
Could be a Hollywood movie.
Yeah, anyone seen Jurassic Park?
Well, exactly, Tim, because apparently if this company called Colossal Biosciences is able to do it, we could actually see extinct animals like the dodo and the Tasmanian tiger, and particularly the woolly mammoth, make a comeback. Now, some scientists say, yeah, but will they be the same ones as existed hundreds and thousands of years ago, or will they be sort of weird, sort of modern incarnation of a woolly mammoth? I wouldn't want to meet one either way, honestly.
I think this is awesome. And although I have seen Jurassic Park and I understand the lessons from which we could take, I still think we should do it.
Dino DNA. So you just wait. The DNA is saved in the blood of a fly stuck in amber. Is that how it works?
Oh.
I don't know.
Goldblum.
Maybe
yes, thank you.
Maybe we should try and solve climate change first.
Still?
Saying.
In
I
Trump
think that's
2.0?
a good idea.
Haven't we?
Well,
Wasn't
actually,
Okay.
this company is actually trying to do a little bit of that as well, though, Carol. Did you notice? Yeah, they are trying to work on some climate-related, things like plastics in the oceans and so on. So, good luck to them. At least they're ambitious.
Yeah, love to see that. That would be a very, very good thing. All right, guys, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We call it Closing Bell. We'll see you again, same time, same place tomorrow.
All right, coming up, we give you the latest update from the Middle East as Israel and Hamas agreed to a ceasefire deal that will pause the war in Gaza and hopefully release a lot of hostages. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Bonnie Quinn.
And I'm Matt Miller. Let's take a look at where markets closed out the day. Massive rally here, up 2%, well, up 1.8% and change on the S&P 500. You can see adding more than 100 points, 59.49.91. So near as damn it to 59.50. On the NASDAQ, we added 2.3%. So those tech-heavy stocks lifted even more. Even the smaller tech stocks really got a huge boost from the drop in rates, 21,238 there. The U.S. 10-year yield, 465, which, by the way, that still puts us in what we would have called the danger zone a couple weeks ago. It's so much better than where we were yesterday, dropping 14 basis points on relief from the CPI number, the core number that came in better than expected. And then crude. This is the standout asset for me over the last couple of days. We continue to watch crude march higher. This is NYMEX at over $80. Obviously, we're looking at Brent that's even higher, I think about $82 right now. So watch oil, because even with the ceasefire in the Middle East, we still see energy prices continue to climb. Bonnie?
Yeah, and let's take a look at the day's biggest movers, or some of them, because really everything was a big mover today, and that was the biggest banks. And surprise, surprise, JP Morgan posted the biggest profit in Wall Street history. That's ever. Well, investors did reward the company, but not as much as they rewarded some of the others, like Goldman Sachs and Citigroup, where we saw also massive profits. Also, Citigroup announcing a $20 billion share buyback over the next couple of years, and that really pleased investors. And of course, some of these stocks were a little depressed, although many of them were up 50% in the last year. Coinbase Global as well, up 7.6%. I put that in as a proxy for all the Bitcoin-related stocks. As you can see, they are rallying big. Bitcoin itself went over $100,000 before closing at least the regular session below that. But we have shares of really everything gaining today. But you can see the biggest gains in the beginning of the earnings season, and also Bitcoin, some of those risk assets, Matt.
All right, let's turn now to the Middle East. Israel and Hamas have agreed to a ceasefire deal, bringing a temporary halt to the 15-month conflict. Joining us now is Bloomberg's national security reporter, Nick Wadhams. So, Nick, what are the details, especially when it comes to the hostages? Because a ceasefire is the first step, but what everyone really wants after bringing an end to the violence is to bring these hostages home.
Right. So what we know so far is about 36 hostages, 33 hostages will be released in this opening phase in exchange for hundreds of Palestinian prisoners. But then so much beyond that hinges on conversations that are still to be had, negotiations between Israel, Hamas, and the mediators. There are many more hostages, including Israeli soldiers, who are still being held, and still those releases would come later on. So what we're seeing here is a first phase in which hostages, including some Americans, according to President Joe Biden, will be released. But by no means would this be all of the hostages who are still being held by Hamas.
No, and also we don't know how many, bodies will be coming home as well, Nick. And the president did mention the word bodies at one point. I did want to ask as well, he mentioned that part of this deal is that Gazans will be able to go back to where they came from, wherever that was. But we also know from Jake Sullivan that Hamas has been recruiting, right? Since Sinwar's death, we have seen the ranks of Hamas also grow again. Is this going to be a concern in Israel even as these hostages are returned?
Yeah, I mean, what we're seeing is some backlash from Israelis toward the deal. There's a celebration on the streets in Gaza and also a lot of relief about the fate of those hostages. But what we do know is that Israeli forces will pull back from population centers in the Gaza Strip. However, if you look at the underlying fundamentals, some of the problems that have delayed and stymied ceasefires in the past are the situation essentially remains unchanged, where Israel has said it will keep up its fight until Hamas is no longer capable of governing in the Gaza Strip. Hamas says it's going to keep fighting until Israel is evacuated completely from the Strip. Neither of those two conditions have been met. So there are a lot of unknowns about where we go from here. And then, as you mentioned, U.S. officials have said, listen, despite all the destruction, the massive Israeli campaign, what they're seeing is that Hamas has essentially been able to keep up its recruitment numbers and replenish the forces that it has lost. So at least from the U.S. side, what we're hearing so far is that Hamas has not been defeated. It still has the soldiers to keep up that fight. So still so many questions to be answered in the next succeeding phases of these ceasefire talks.
Absolutely. Phase one is set to last 6 weeks with implementation beginning Sunday. Nick, thank you so much. That is Bloomberg's Nick Wadhams there. Turning to the US now, cabinet confirmation hearings in full swing with all eyes on Donald Trump's pick for Treasury Secretary Scott Bessent, who faces the Senate Finance Committee tomorrow. Joining us now is Henrietta Treyz, Director of Economic Policy at Veda Partners. Henrietta, thanks so much for joining. How are the hearings going so far, and is Bessent a shoo-in?
Well, the hearings today were a lot better than they were yesterday, so I think those were going really well. I think Scott Bessent is, in fact, going to have a pretty easy path to confirmation in the next couple of weeks. Indeed, I think after Marco Rubio, he might be one of the easiest candidates that gets confirmed. There are some more contentious candidates that will get held up. There's some newfound opposition to RFK Jr., but we also think that he will get through, though there are some others, Tulsi Gabbard, for example, who will face a lot more Democratic scrutiny. Kash Patel is gearing up to, from all indications we got today, face a tough audience when his confirmation comes up.
I would think if you can get Pete Hegseth through, you can really get anybody through. Will he face any opposition from Republicans when it comes to the actual vote?
I imagine not. There was some really helpful, holdouts from Joni Ernst, for example, that I think will give a lot of cover to any of the other Republicans that might have been on the fence. Obviously, he will not get any Democratic support, but it looks like he will get the minimum number of Republican supporters when he goes through his confirmation as well. They definitely rallied around his candidacy yesterday.
Henrietta, we'll then get the executive orders, and later in the year, possibly, maybe earlier, we'll start looking at, tax proposals and so on. But I'm curious, do you imagine that the beginning of the administration will be as chaotic as it was last time, or should we see a much more tamped down, organized approach?
My approach to all things executive branch is to think about how long it's going to take the legislature to actually get a bill through. We're looking at least April until we get even one small scale bill on just border and energy policy. So I'm expecting robust executive orders on day 1 through, 10 of the incoming Trump administration, a lot of tariff action, IEPA certainly, potentially pulling out of the phase 1 China trade agreement, or acknowledging that we're going to hike tariffs under Section 301. And then on the executive order front, I expect a lot of action there as well, although that's going to be more headline than actual bite. Things along the lines of announcing studies around energy, LNG production and export, crude exports, what to do there. And then a lot of the red meat stuff, pardons for January 6th insurrectionists and things along those lines, but heavy on the executive action front for the first 3 months of Trump's administration in the absence of legislative progress.
Trump used IEPA to ban TikTok back in 2020. That was before he was for TikTok. And of course, federal courts overturned that. Is he going to have any trouble using it to put tariffs into place?
No, that's a good reminder. I had been so concentrated on his tariff IEPA stuff, I'd forgotten about the TikTok piece. On IEPA, there's really no oversight needed from any cabinet officials, unlike some other trade remedies like 301 or 232 that require something like 270 days worth of investigation or communication with Commerce or USTR or other federal agencies. In the IEPA case, he can just proceed and go forward as much as signing it with his Sharpie. So one of the things I think we want to be mindful of is that in the past, and specifically in 2019, when he announced that there would be IEPA tariffs on Mexico, the implementation date was not until about 10 days after he signed the IEPA announcement, and those tariffs never actually went into effect. So I'm expecting, in the best case scenario for investors worried about inflation and for companies worried about these tariffs, that they will be a lot of headline, and then in the intervening 10 or 15 or whatever number of days, Canada and Mexico will be able to come to the United States, threaten their own tariffs, specifically on various certain exports that are like aluminum or uranium or zinc, things like that.
Henrietta, thank you so much. We'll know more from Monday. That is Henrietta Treyz, Director of Economic Policy at Veda Partners. Coming up, we're going to discuss the latest round of layoffs set to impact Meta's workforce. That's next. This is The Close on Bloomberg.
Meta is adding its name to a seemingly growing list of companies planning layoffs in 2025. The company is going to cut 5% of its staff through performance-based terminations, affecting roughly 3,600 jobs. Joining us now to discuss is Andrew Challenger, Senior Vice President, Challenger, Gray and Christmas. Andrew, great to have you on the program. You're kind of like labor market royalty. What do you think about these layoff announcements that we've seen? If I look at ECAN data from the Bloomberg, one of my favorite functions on the Bloomberg, we see that announcements of job cuts, at least at the end of 2024, really tapered off to almost a 2-year low. Here's the chart. Are we going to see this pick back up?
Yeah, I do anticipate that we're going to see layoffs start to pick back up, at least in the first quarter of the year. We've seen this slow cooling in the labor market happening for over a year, right? A lot of that is in line with as the Fed lowered interest rates, they expected to see, raised interest rates, expected to see the labor market cool. That is what we've been experiencing. These cuts at Meta are unique. They are in the announcement, these cuts are because they're trying to get rid of low performing employees. And they do in the statement say they're going to backfill those positions throughout 2025. So it's not as strong of a negative signal on the market. And in fact, some ways it's a strong signal that Meta feels like they're able to make this cut because they're, as an employer, in a little bit more of a positive position compared to the last couple of years.
Andrew, we were just talking with somebody from LinkedIn who said that people are now applying for 2.5 jobs on average as opposed to 1.5 jobs about 4 years ago. Are you seeing similar dynamics at play in this work environment? Is it a place where people just fling their resumes everywhere?
Yeah, the way job opportunities have become posted on LinkedIn do make it very easy for people, even when they're happy in their role, to quickly apply to jobs left and right. That does leave a lot of recruiters going through piles and piles of resumes, making offers to people that they don't eventually take. However, we're seeing a slowdown in overall job change activity. We're not in that 2021, 22 market where it was the greatest labor shortage in American history and employees had such a strong position to find new roles and negotiate. We are slowly seeing that move back in favor of employers over the last year and expect to continue to see that throughout the year.
So does the labor market really feel slack? Andrew, is that a word you would use right now? Because that's the only reason I could understand a new bout of layoffs.
Yeah, we're in a strange moment, right? We're in that did the Fed overcorrect and we're going to start to see the labor market really start to get hurt, or was it not quite enough? We don't know yet. We only have a few pieces of data. We're still at 4.1% unemployment. We are seeing people land in jobs relatively quickly. So there's a lot of good reasons to remain positive about the labor market. But just from our conversations with customers and companies, we do expect to continue to see layoffs at least through the first quarter.
All right. Thank you so much, Andrew Challenger. Much appreciated. Senior Vice President at Challenger, Gray and Christmas. Just want to bring you this news now. Hindenburg Research, that's of course Nate Anderson. He says that he is going to disband the firm. He just posted this on Twitter, a letter, a personal note from our founder, and it just got shared with family, friends, and our team. That's Nate Anderson's Hindenburg Research disbanding the firm. This is Bloomberg. Hindenburg Research's Nate Anderson has told everybody that he is disbanding his firm. He sent a letter to partners and friends and also to staff, a team of 11 people at Hindenburg Research, saying that it was time for the company to disband. He said that the team didn't come from traditional finance backgrounds, and he tells the story of how the team got built and his desire for making a change really in these markets. But that is Hindenburg disbanding the short seller, of course, Nate Anderson, whose targets included people like Rivian and many, many others.
All right, let's get back to the massive rally that we saw today, the drop in rates, and the inflation data that really kicked it all off this morning. You're looking right now at a chart of the super core. This is, the prices for everything that you don't need to buy, falling to the lowest month-over-month growth since July. Now, if you put back in housing and food and oil, then you're going to see that we didn't get such a great reading. It was actually 0.4% month over month, 2.9% year over year. So are we seeing an inflection point here? Is inflation coming back down, or is it still stubbornly high? Fed officials welcome the new data. John Williams, Tom Barkin, Austin Goolsbee, all expressing confidence that inflation will continue to slow, and the market seems to agree. Let's ask Jim Bullard, Dean of the Mitch Daniels School of Business at Purdue University. He also is obviously the former president of the St. Louis Fed. Jim, great to get some time with you. What do you think about inflation? Can you see a trend in one direction or the other? Did we get a change with today's reading?
It is encouraging news for the Fed. I think they've been saying that inflation will come down, but I think doubts were starting to be raised when you had 4 readings in a row at 0.3, and the refrain that inflation has been stickier than anticipated, certainly true during 2024. But this gives hope that inflation will now resume its downward descent during 2025. That would enable the committee at some point, not soon, but at some point to lower the policy rate a little bit further.
What do you think we should expect the effects of the next Trump administration to be on inflation? Because there are some moves Trump wants to make that have been celebrated by the market. Tax cuts, lower regulation should support more growth, but also could be inflationary. The same is true of tariffs and deportations. Although we don't know, we would only be speculating to what extent we're going to see those. Still, everything seems ready to push prices higher. What do you expect in 2025?
I expect a good growth environment, and certainly the initial conditions for economic growth are very good. So, and then combined with I would just broadly say the pro-business agenda bodes very well for 2024. For 2025 and going into 2026. So that part I think is good. I think the story that tariffs are going to raise inflation, I don't think that's a good one. It's not something to bet on. I would also say that the immigration story is not a good one to bet on as far as inflation outcomes. I mean, you could study monetary theory for 3 decades and you probably never hear anything about tariffs or about immigration having an important impact on inflation. So I think those stories, came out of the campaign, but I don't think either one of those will be have any lasting inflation implications.
Jim, we have
You heard it here first.
Yes, exactly. We'll make sure to cut that soundbite, Jim. We have had, since last week, the likes of Goldman and JP Morgan cut their forecast from 3 cuts to 2. We have Mizuho and Bank of America saying there are going to be no more cuts. And then I believe Citi is still at 5 cuts for 2025. How many cuts are there going to be, Jim?
It's going to be about 2, and I think the committee says as best they can how they think 2025 will develop. It's possible that inflation will come down faster than anticipated, and then absolutely the committee would adjust to that, but it's just as possible that inflation will be, despite today's report, will be unexpectedly sticky. And then the committee would have to stay higher for longer. Some people have said, "Oh, there'll be possible rate increases in 2025." I don't really think the committee has to do that. I think what they can do is, if inflation is sticky, or even if it ticks up a little bit, they'll just stay where they are, and they don't need to really do anything major about that, unless it was a major side-up move on inflation.
But Jim, how anchored are inflation expectations? That's definitely one area where there's cause for concern, right?
Yeah, I noticed the Michigan survey. I've never liked the survey evidence. It tends to have a political element to it. You get different readings between different demographics as well. So I prefer the Treasury tips market. It has gone up a little bit, so something to keep an eye on. But
Jim just froze. Oh,
he froze there. You know what's interesting? He was talking about the University of Michigan survey. We got you back, Jim. You were talking about University of Michigan survey, and I find it so fascinating that when you look at the data a little bit deeper. You see that Republicans expect almost no inflation, right, out 1 year, and Democrats expect like 4% inflation. That doesn't really make much sense, does it?
No, it doesn't make sense. And that's always troubled me about these survey-based measures, is that you have these weird effects going on like that, which makes me think they're not really about, or not entirely about inflation expectations, but about maybe political outlook or something like that. And so that's in a way, it's a polluted measure of inflation expectations. So that's why I'd like to look at tips markets instead. That has gone up a little bit, but I think the committee can keep that under control.
Jim, curious as to your thoughts on communication at the moment. It feels like we had to have a lot of changing lanes last year. I mean, part of it was because the market went from thinking there would be 7 cuts to realizing there would, just be 1 or 2 or, a few at the very most. But is the communication sort of at its best at the Fed right now?
They've had I think, a difficult time in the second half of 2024. It was, to be fair, I think it was a complicated story to tell. They felt like the policy rate was too high in the 5% range. They had to tell a story about recalibrating without saying that they saw something wrong with the economy or that they thought that inflation wasn't going to come down. So that's a hard message to get across. It's no wonder there's a little bit of confusion out there in markets about that, but I think the chair did admirable job in trying to get that message across, even though it's a difficult one.
Jim, thank you so much for your time today. Very appreciated. That is Jim Bullard, Dean of the Mitch Daniels School of Business at Purdue University. Let's take a look now at how markets closed on the day. Well, for equities, it was certainly higher for yields too. The S&P 500 was up 1.8%, bringing it now into the green for the year 2025. We had the Nasdaq 100 up 2.3%, and I believe Matt Miller earlier said that it was in a relaxing zone, the 10-year yield, 4.6531, as opposed to stressed, maybe towards 4.75.
Danger zone is a term that I love, and a lot of people have used for a 10-year yield above 450, but we started to really worry about 5.
Well,
right?
That's the point. 5 had really come into the conversation. The dollar index, the one that I tend to quote, is at 109.14. Matt quotes the BBDXY, and that, of course, weakened, but it's also a little bit stronger as well. This is The Close on Bloomberg.
Johnson & Johnson at risk of losing its AAA grade from S&P Global Ratings after announcing it is acquiring Intra-Cellular Therapies. The deal between J&J and Intra-Cellular is expected to close later this year for about $14.6 billion, and that makes it a big one. Joining us for more on the deal and other moves that we're seeing across the M&A space is Bloomberg's Liana Baker. Liana, great to have you on the program. Big deal in biotech, but it seems like 2025 is going to be a year where we see more big deals.
That's what we're expecting, and that was the vibe out of the JP Morgan conference, which we were just talking about. But this is the biggest biotech deal in over a year, so I think there is going to be pent-up demand, and it's not just going to be in biotech. We're looking at other areas. There was a roofing materials hostile takeover, announcement today.
QXO.
So, exactly. And there's going to be other
That was a cash deal, right?
Yeah. So the Brad Jacobs is the billionaire guy behind a lot of different logistics companies, and they've been interested in this company since last year, and it seems like he might even nominate directors. So maybe this one could get a little ugly as they try to exert pressure to make them sell.
What about activist campaigns? Are we seeing any more in the pipeline? Because we've had some results already.
So I've been on with you guys a lot this week talking about Honeywell. That was Elliott Management's last big splashy campaign. So we're expecting Honeywell to announce a breakup, and Elliott was involved in that. And there's definitely going to be more as we see sort of the nomination windows open for these companies.
I want to talk about biotech specifically, or healthcare specifically. You mentioned the JP Morgan Healthcare Conference in San Francisco. We had Katy Greifeld out there doing a number of great interviews. I talked to Stephen Diamond today, who says he thinks there's going to be a real pickup in deals in that space specifically. Are you guys working on more there?
So I wish I could reveal all, the deals we're working on. But one thing I will say is that J&J has been active in other areas that aren't just biotech. I think their last big deal before was in, like med tech devices. Yeah. So, and Stryker this year struck a deal to buy something called Inari, which makes, devices. So that's another area we're looking to see if there's deals to be had. And then, of course, there's insurers and other areas. It's such a vast space.
Healthcare.
And there could be so many changes happening regulatory-wise. So that'll be one to watch for sure.
Liana, thank you so much. Always love when you come on because it means something is going down in the world of business. That is Liana Baker in charge of our deals coverage for the most part here at Bloomberg. Well, let's continue with M&A in healthcare. A new report from Bain & Company showing private equity deals in the space valued at $115 billion globally in 2024, the second highest deal value on record. Could that trend continue this year? Joining us on set to help answer that question is Nirad Jain, Senior Partner and Co-Head Global Healthcare Private Equity at Bain & Company. So, do we get a record year, Nirad?
We got almost a record year this past year. We'll see what 2025 brings. I think deal activity will definitely be up. The all-time high was in 2021. We had $150 billion of healthcare private equity deals, according to our Bain & Company report that year. This year, as you said, we just got to $115 billion. And I think the environment's getting better for deal making. I think people expect more exits. I think there's pressure for a lot of private equity exits as well. So we're optimistic for where the year goes.
So in terms of, I have so many questions about the breakdown, right? Like, where is it happening regionally? And also, we were just talking with Liana about, biotech deals, but also medtech hardware deals. Is there a certain area where you're seeing the biggest concentration?
Yeah, the breakdown's always fascinating. So North America is always the biggest region from a deal perspective. That was true in 2024. I expect that to be true in 2025. Europe actually had its highest year ever in healthcare private equity activity. So we continue to see strong trends there. And then APAC is very interesting geographically, where you're seeing the rise of larger and larger deals in India, more deal activity in Japan and in Korea, as there's just the aging of a population and therefore just more and more services that are needed. From a sector perspective, we saw the greatest amount of activity in biopharma, as you would expect. A lot of that is biopharma services, not actually the principal companies that are doing biopharma. That's been true for many years, but it's interesting to see that service business being high. Healthcare IT was where we saw a huge rebound, and I think we're going to continue to see an increase in activity in that sector as well.
Yeah, I mean, that's where I was going to go. I mean, are we talking about the hot sectors being devices and services, or pills and therapies?
Yeah, I think neither. I think it's actually, from a private equity perspective, the services industries that serve those medtech companies and those pharma companies. So as you think about trends like onshoring and bringing supply chains to be both more resilient, but bringing more supply chain into the U.S., they're going to need service providers to go and do that. If you think about technology enablement behind pharma innovation and production, or medtech innovation, or just delivery, right, payer-provider services, you're going to see more of that. So it's a lot of these businesses that are fueling access to care, which is what the investors in the private markets are interested in.
We got an announcement the other day. Illumina and Mayo Clinic are both working with NVIDIA. Struck me as a little bit of a marketing thing, right? Because obviously they're going to be working with AI. But is that a big part of your business this year?
I mean, of course, you're going to see a lot of sizzle around generative AI, but there's actually a lot of activity that's going on that we don't all yet see as consumers, or even as primary investors. Public market investors won't see a lot of what's going on. But there is going to be a lot of, I think, technology enablement in healthcare. Just take our industry. It is the industry sector that is probably least invested in technology. Like, compare it to your banking experience as a consumer. Your healthcare experience is very different. So technology enablement is going to be a trend. Is part of that going to be AI? Of course.
Nirad, how is the financing getting done? Where is the most interesting part of the financing for this happening?
You mean from like a loan perspective?
Yeah.
So debt's becoming a lot easier to get in larger amounts. That was a problem for a few years.
Is that because everybody wants some private credit?
Private credit is the hot term, right, out there. And yes, there's a lot of private credit that's available. But I think banks are also increasingly eager to lend as they see some stability in the rate environment and, a more optimistic outlook. So debt is absolutely available. And I think that's also fueling some of what we saw in the 2024 increase and what we think is going to lead to some 2025 increase.
All right, fascinating stuff. Hope we can get you back, Nirad. Thanks so much for joining us. Nirad Jain there, senior partner and co-head of global healthcare private equity at Bain and Company.
Back to the breaking news now about Hindenburg Research. Founder Nate Anderson has decided to disband the research firm, which has released prominent reports on market manipulation and accounting fraud. Joining us now for more on this is Bloomberg's Carmen Reinicke. So this just crossed a little while ago. Nate Anderson putting out a statement, a letter essentially saying that the plan had been to wind up after they finished the pipeline of ideas in the works. But I bet there are some potentially shady figures out there around the world that are breathing a sigh of relief right now, Carmen. Is that true?
Yeah, I'm sure that is definitely true. I mean, Hindenburg was one of the most prolific short sellers on Wall Street and has had a really spectacular run over the past 2 years. I think the biggest call that they've made was against Adani. Obviously, that had huge implications for that company. Their last two calls were on Carvana, Roblox, also big major companies that saw, huge stock drops from these reports. So it is a surprise. It's also a very difficult time to be a short seller. So there is, I think, a little bit of, some maybe expectation that this would be happening. Last year, I wrote with another reporter here that just some of the biggest and the best had been bowing out. Jim Chanos, for example, converted his office to a family fund in 2023.
he had also stepped out of the game. So we've seen it a very difficult environment. Andrew left of Citron, obviously in trouble with the SEC. It's just it's a tough time to be a short seller, which I think is sort of an evergreen statement, but yes.
Yeah, very difficult. I have this image in my head of Andrew left, like smoking a whole pack of Marlboro Reds, waiting by the phone, like looking through the curtains, worried about someone coming to get him. Well,
I don't.
I talked to him in a live interview, and he was like, dude, I'm freaked out right now because there's always feds out my window. But is this a concern? Do investors have a concern that this kind of removes some of the guardrails from the market? You count on short sellers to some extent to hold down the fraud, right? And if you don't have them there, you only have government employees to do that.
Yeah, I think that that's a really important thing to remember. People that are really champions of short selling would say this, that it helps with price discovery, it helps uncover fraud in the market. It's beneficial for investors, actually really on both sides, to have some sort of a guardrail, as you said. So I think that's a concern, definitely.
What was fascinating, particularly though, about Nate Anderson is that he went after global targets and like massive targets, and maybe that's a scenario in which you are looking out your window. But Adani Group, for example, as you said, Temenos, Renovaro were some of them, in Europe and in India and all over the world. Mm-hmm. It's not every short seller that goes after global companies, although some have gone after Chinese companies too.
That's true. He really did have a very broad scope, or I guess I should say the research firm had a very broad scope. As you mentioned, there are some that focus on China, but Hindenburg really had ran the gamut and had a lot of really fantastic calls. And I think, even in 2024 had a really fantastic year.
Just briefly, Carmen, for Nate Anderson, it wasn't, it's never not about the money, but he would always say that it was more of a research firm as opposed to a sort of a money-making venture, right?
Yeah, I think he was one of those short sellers that was really into the research, really into the investigation piece of the puzzle, and really into uncovering fraud, which is sort of a little, niche, a little part of that sector.
Remember, he went after Supermicro, and I think it was before their auditor said, we're out.
It was
like, we can't sign off on these figures anymore.
Hours before, and the stock plummeted. It hasn't recovered, yeah.
All right, Carmen, thanks so much for joining us at short notice. Carmen Reinicke there covers the markets for us at Bloomberg News. Still ahead, what investors need to watch over the next 24 hours. That's a pretty deep tease. This is Bloomberg. As promised, we are now going to look ahead to what you need to be watching over the next 24 hours. And earnings.
Morgan Stanley and Bank of America. Matt, you'll be up early on open interest to break down all the ramifications of what we see in those reports. If it's anything like today, we'll have another big blowout report from those banks.
Yeah, the most important part of the market day is clearly the open, and I will be anchoring that together with Katy Greifeld and Sonali Basak. We'll bring you through all of these bank earnings on which we focus very closely. We're also going to get retail sales and jobless claims, so the economic data coming out around that time as well, which is what makes open interest so important.
Well, and by the time I take the seat at 12, which is right after his show, I can't remember what he called it, we will be tuning in to the confirmation hearing of tomorrow. Likely Scott Bessent, right? He's going to be the Treasury Secretary. He's, if he gets confirmed, he's right now the nominee, the delegate, and there will be a lot of questioning. We'll be listening in.
Yeah, pretty safe to assume that he gets confirmed. If it looks like Pete Hegseth can get through, I think Scott Bessent can sail through. We also still have to get the Supreme Court decision on TikTok, remember?
And that might come at any time, right? 10 a.m. or any other time.
I imagine tomorrow or Friday, because the 19th is the deadline, and I doubt they work on Saturday and Sunday, but I could be wrong.
How are you in the News Gods books?
I have good karma right now. That does it for Balance of Power.
Tune in then.
That does it for us. Balance of Power is up next, I should say. Have a great Wednesday night. This is Bloomberg.